Well, there's certainly a lot of good news that is priced in right now, that's for sure. And there's really little wiggle room for bad news or bad data, both on the inflation front as well as on the economic side of things. Yeah, you look at the market right now, trading almost right at around 20 times earnings. That's very rich. This AI euphoria has really grabbed the market by storm. But we can't forget there's still a lot of headwinds out there, and we are not out of the woods with the Fed, and we are not out of the woods trying to figure out what type of landing we're going to actually have.
What do you think's buying the market, Tim? I've heard a lot of mixed messages about what the retail investors are doing, what the institutions are doing as well. Who's driving this market to new levels on the back, as you say, of this most optimistic scenario?
Well, really, it's a little bit of both, but ultimately, when we're talking to investors, we're encouraging them to keep a risk-aware stance, not risk on, not risk off. There's a lot of headwinds out there. There's a lot of uncertainty. But really, what's most important right now, and I think what's been proven over the last 4 months, is you need to have exposure to the equity market. If you went in bonds back in October, you missed a very big rally. So we're seeing a lot of investors continue to gravitate towards strategies like buffer ETFs that allow them to maintain exposure to the equity market with a downside buffer against losses over an outcome period. So investors really like that defined outcome approach right now with all the uncertainty that we're seeing out there in the market.
Even though the market has done so well since its October 2022 low, I mean, when you really think about it, it's been driven so much by 7 big name stocks, i.e. some of these mega cap tech names, the superstars. So some people are saying, don't look at the headline numbers, even though officially S&P is now in a bull market in inverted commas, actually maybe it's just a bear market rally because of the narrowness of this rally. What do you think?
Well, it's very tough to tell. And if you look back historically at bear markets, these extended rallies are actually very, very common. And really, ultimately, what's going to determine if this is a bear market rally or a new bull market is what type of landing we have. A hard landing scenario is going to be much different, obviously, than the soft landing scenario. Interestingly enough, though, you look historically, investors always get excited around the prospect of a Fed pause, a Fed cut. But ultimately, what's going to determine the direction of the market is what is the outcome here. And you look back historically, taking rates from 0 to 5% like we have right now, that typically doesn't come without consequences. So again, we're being very cautious and not just jumping to the conclusion that, hey, we're in the midst of a new bull market here.
Is it very academic whether or not the Fed pauses or hikes or does whatever this week? Because at the end of the day, if it's committed to keeping its rates higher for longer, that in itself is kind of like a form of monetary tightening. And if you're, for example, a small and medium-sized business and you're trying to get a loan and you're finding that you're being either rejected or your rate is over 10%, that feels like a hard landing. It becomes an academic, sort of almost philosophical kind of conversation, doesn't it?
It does. And the reality of it is, whether we get 1 hike or 2 more hikes, whatever it is, the Fed is likely going to keep rates higher for longer. And we think investors really need to focus on how do we invest in this new world. We're not in the old regime where rates are at 0. We need to think about how do we invest in a world where interest rates are higher for longer. They're not just going to jump to rate cuts too soon. That could come with a lot of consequences for inflation extending beyond what it needs to. So again, how do we invest in a world where rates are higher for longer? Really what we're talking to clients about is figuring out ways to really reduce some of our bond exposure, get more equity exposure in the portfolio. Again, going back to some of those buffered strategies such as PJUN, which is a 15% buffer on the S&P 500 ETF over a 12-month outcome period. Historically, that strategy has about half the volatility of the S&P 500. So not exactly bond-like volatility, but a way for investors to be able to get more equity exposure in their portfolio without taking on the full risk of the equity market. And in this new regime where we need a new playbook, we think strategies like buffer ETFs are really a great way to do that.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.